Hello. In this video, I will be talking about the income statement. Income statement is one of the important financial documents that we use to show the financial performance of a company. And this is required by a federal agency, SEC, which is Securities and Exchange Commission. If you look into any income statement, you will see 5 parts. These are number 1, revenue, gross profit, 3, total operating expenses, number 4, EBITDA, number 5, net profit. And let's go and talk about each one of these components. Okay, the first part is the revenue. Number 1, that's the revenue, and revenue could be from operating or non-operating revenue. The operating revenue is the money brought into the company by its business activities, such as selling a product or providing a service. Non-operating revenues, these are the money generated from non-core business activities, such as income coming from advertisement displayed on a business property, or rental income from a business property. These are kind of things. So revenue could be from operating or non-operating based on where this money coming from. If it's a core business activity, this is an operating revenue. If it's non-core operating, if it's non-core activity, then it is non-operating revenue. The second part is the gross profit. The gross profit is also called the gross margin as well, is the money generated after paying all the costs and expenses directly related to producing a product or services. How we can calculate this? This can be calculated by subtracting the cost of products or goods sold from the revenue. Third part, this is called the total operating expenses. The total operating expenses is the total expenses incurred over a given period of time due to normal business activities. This could include the rental, the payroll, the marketing, the insurance, the equipment, administrative expenses, or any expenses related to research and development. Now, this is the fourth part, which is the EBITDA. The EBITDA is a term, really a short term for earning before interest, taxes, depreciation, and amortization. We subtract all business expenses, direct and indirect, from the revenue in this part. It can be calculated by subtracting the indirect expense, which is part 3, from part 2, which is the gross profit. And in this part, we do not include the taxes or depreciation in this part. We will include the taxes and depreciation in the next part. The last part of the income statement, of this financial statement, it's called the net profit. And the net profit basically called the bottom line, or how much money you could keep into your pocket. This part in particular shows the profit generated by a business after paying all expenses, direct, indirect, taxes, depreciation, and the amount remains for the company to take home, invest, or to sell. Here is an example of a statement, income statement. If you look into this, revenue is 1.1 million. Expenses which is basically the cost for goods sold, that would be 600,000. Now, if you subtract the 1.1 million from 600, that would leave you with a 500 as a gross profit. However, there's other expenses that we should consider, which is sales and marketing expenses. That would be 100,000. And we could calculate the percentage of these revenues. So that would be 45% of the 45% of the total revenue would be based on the gross profit. 9% would be based on the revenue, which is 100%. And then research and development, that would be 50,000. These are calculated by showing the expenses, how much we spend on these expenses. And general and administrative expenses, 75,000. Adding all these together, the total expenses would be 225,000. This is coming from 100 plus 50 plus 75. That will give you 225,000. So the profit, the operating profit or EBITDA would be the 500 minus the 225. That will give you 275. And now, considering the interest that we will be paying, that would be 55,000. Depreciation would be 5,000. So profit before tax would be 215. And this is coming from 275 minus the 60,000. Consider the taxes to be 53,750, and that would leave you with a net profit income as a $161,250 as the net profit. All right, let's take a look into the Excel sheet, the example. Here's an example showing the income statement for a company. So the gross profit would be subtracting the 1,010 minus D7, which is that cell D7. That will give you 500. If you look into the percentage, that would be dividing the 500 over the 1.1 million. That will give you 45%. And now for the sales and marketing would be 100,000 that's given to you or collected through the accounting department. And that percentage calculated by dividing the 100,000 by 1.1 million, that will give you 9%. 50,000 for research and development, that's the expense, which would be 5%. And again, this is given or collected from a different department. And general administrative would be 75,000 collected from the accounting department. That's equivalent to 7% of the revenue. Now for the total expenses here, the total expenses would be this one plus this plus 75,000. That will give you 225. And now for the operating profit would be 500 minus the 225. That will give you 275,000. If you need to calculate the percentage, you divide 275,000 by 1.1 million to give you 25%. Interest is given to you. Your company will be paying 55,000. Depreciation would be 5,000, and profit before tax would be subtract the 275 minus the 60,000 here. That will give you 215. In the taxes, that would be just multiplying the number 215 times 25%, according to a percentage given to you or what you have to do, how much you have to pay. That is calculated to be 53,750, 725. And then the net profit would be equal to what here? The profit would be equal to 500 270 275 minus the net profit would be equal to 500 minus, okay, well, we'll use this one here actually. We'll use this one, 275 minus, actually the best way is to use this number, 215 minus the taxes that you paid. That will give you 161,250. And you could calculate the share by dividing the 100. This is given to you by the profit, so that would be the earning per $1. If somebody invested in your company, they will earn 1.61 in earnings. All right, now how this is important, we need to compare it with previous year with the current year. So for example, and see how that's going to do, and if there's any concern for us between the 2 years. So we're going to do the same thing here. We're going to calculate the gross profit by subtracting this minus F7. Let's do the same thing for here. The total expenses would be 120 plus 60,000 plus 85. And now the operating profit would be 820 minus F16, 500. Exactly, did the same thing here, 555,000. And now for the net profit would be equal to 5. Already did the calculation here, 45,000 and 5,000 here. Profit, we know the taxes here. So we could do this one. And this one, actually, I'm going to do this one minus the taxes. And that would give you 375. And let's take a look into the changes between 2014 and 2015. And this is what would be the difference. The changes, if you see in the revenue, there's an increase in revenue by 38%. The gross profit increased by 64%. Total expenses increased by 18%. Operating profits, it's excellent, increased to 102%. And now, is this, look into each one of these, is this concerning? No, this is not concerned. And how about this one? No, we're not concerned about the gross profit. Same thing for operating expenses, 18% here, which is less than the profit, less than the revenue. So there is no concern here. We are not concerned here. Same thing for the net profit here. We're not concerned at all. And that would be how the income statement is used, how it's calculated, and it's just helpful to make financial decisions. I hope this is helpful. Please let me know if you have any questions. I will be making another video on the rest of the content for chapter 1. Thank you so much.